Another strong week for monetary precious metal values. The silver spot price is trading late this week around $17.50 an ounce in fiat U.S. Federal Reserve notes. The gold spot price is trading 1,530 fiat U.S. dollars per troy ounce near the end of the week as well. The gold-silver ratio has ticked down 1 troy ounce lower this week. It now takes 87 derivative ounces of silver to acquire 1 derivative ounce of gold. About 9 months ago, we last spoke with this week's Metals and Markets Wrap guest regarding the first long-time JP Morgan precious metal derivative trader who admitted guilt to financial fraud and market crimes committed in late 2018. This week, we welcome back longtime silver analyst Ted Butler to the show to discuss yet another guilty plea by another over-decade-long executive director from JP Morgan's precious metal trading division for the financial market crime of spoofing. We hear Ted's take on the U.S. Department of Justice and the various indictments on precious metal market criminals it's made over the past year's time. As well, we also discuss a likely massive silver trade which has formed in the last 3 months of time in 3 of the most major silver ETF derivatives, to the tune of a silver bullion hoard the size of both the former Hunt brothers and Berkshire Hathaway's Warren Buffett respectively. We discuss who is possibly making a multi-billion-dollar move into the physical silver investment market and what this kind of move may portend for some of the precious metal derivative trading entities on the short side of silver moving ahead. We'll be right back with Ted Butler after this brief message from our show's sponsor. SD Bullion is a high-volume, physical precious metals dealer here in the USA. If you are acquiring an investment-grade bullion position, be sure to bookmark www.sdbullion.com/deals, where each and every week we source some of the best bullion deals for our over 100,000 customers worldwide. At the bottom right section of our website, you can also easily subscribe to our weekly Bullion Deals mailing list, where you will receive weekly notifications of valuable product deals that may be exclusive only to our SD Bullion mailing list. Stay tuned to sdbullion.com, the lowest price, period. Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week, a returning guest is Mr. Ted Butler of Butler Research. Ted, thanks for coming on the show and taking time today for us and our listeners.
Thank you, James. It's good to be here again.
So last time we spoke, it was about 9 months ago. It was late last year in 2018. And it was right after a longtime former JP Morgan precious metal trader named John Edmonds. He had admitted guilt to the U.S. Department of Justice for manipulating precious metal prices through COMEX and NYMEX derivative futures contracts, spoofing. And this week we have a second trader, Christian Truns, who admitted guilt to the U.S. Department of Justice for essentially doing the same thing. And the time frame that he was working for JP Morgan as an executive director was roughly 11 years. He admitted to doing spoofing with precious metal contracts from the summer of 2007 all the way to the summer of 2016. And he was working in various offices for JP Morgan. He did it in the London branch, the New York branch, and the Singapore offices. So it seems pretty pervasive that they were doing this all over their company. And then this summer as well, we've had a couple other things where the U.S. Department seems to be going around and hammering people for the spoofing crimes. It looks like they got a former trader who worked for Naked Silver shorting Bear Stearns before they went bankrupt, and then this trader, after Bear Stearns went under, he went over and started working for Scotiabank's precious metal trading desk, and he got in trouble with the U.S. Department of Justice for doing the same admitted crimes, essentially spoofing precious metal contracts from the summer of 2007 to the summer of 2016. So the time frame is similar to this Christian Truns character who just admitted guilt for JP Morgan. And then as well, the final other bust that I saw that the U.S. Department of Justice did, they essentially got the Merrill Lynch commodities trading desk to pay a $25 million fine for trader spoofing crimes. And the time frame there was beginning around summer of 2000. Well, it says at least 2008, continuing through 2014. No individual traders were singled out, and no one appears to be going to prison. There was no disclosure of any ill-gotten gains being returned from the actual individuals who got bonuses from such crimes. And I suppose the shareholders get to eat the fine, I suppose, but such is the case. It looks like the Department of Justice is going after a lot of these traders and looking to rebuke some of the crimes that have happened. I wondered, obviously this news this week was important because JP Morgan was involved, but this is a bigger trend, it seems. So I wanted to get your thoughts on the whole perspective of what's going on.
Sure, that was a pretty good summary. Basically, the Department of Justice and the CFTC, after years, close to 10 years of benign neglect, overlooking the spoofing, the phony trading, and the sharp movements up and down that were artificially induced, something obviously woke them up, and they started to go after what was basically obvious to most market participants that followed things closely, that they finally cracked down on spoofing. And it's a good thing. I guess it's better late than never. So it's good. And I would think that they've probably gone a long way to, they being both the Department of Justice, which has the ability to bring criminal charges, and the CFTC, which is strictly on a civil basis. They basically eliminated spoofing. Again, they should have eliminated it a long time ago. It never should have been allowed to exist. There's just completely devoid of any economic substance or legitimacy. But again, better late than never, in that they have cracked down on it. I don't think their job is done necessarily as far as the broader manipulation, but I would like to get into a bit the difference concerning yesterday's or the day before's announcement of a second guilty plea at JP Morgan, because JP Morgan is standing out here much differently than the other cases that you referenced. And basically, where it stands out is that in these other cases, as you pointed out, James, they're basically, I don't say rogue traders, but there was no accusations or allegations that the traders at these other firms, other banks, were doing what they were doing, spoofing, with the full knowledge and of their direct supervisors, and no allegations whatsoever that they learned their spoofing craft, from more senior traders at the firm. Only JP Morgan has been accused of this. If you read the Justice Department's actual announcement, both for John Edmonds and Kristen Trunz, you'll see that the wording is identical, that they learned it from more senior traders. They did the whole thing with full knowledge and permission of their supervisors, and that makes, to me, all the difference in the world. Because I'd ask you to step back a bit and think of this in a different perspective. And I'm surprised nobody's really brought it up yet. But these were basically kids, 23 years old or so, that when they first went to work for JP Morgan, and having been in that same position many years ago, unfortunately, I started out with Merrill Lynch, and I was about the same age, maybe 24, 25. You think you know a lot at that age, but as time goes on, you realize you don't know too much. And I can put myself in the position of these two traders who did plead guilty to spoofing, criminal charges, no less. They potentially could get jail time, even though I kind of doubt they'll get a lot or any because they are cooperating. But look, they went to, just like I went to Merrill Lynch and was happy to have the job when I was 24, 25 years old. And these guys were probably feeling the same way, glad to work for J.P. Morgan, prestigious financial institution. And don't know anything. None of us knew anything at that time. If somebody tells you at the firm to jump, you say how high. Okay, you don't question anything. You just do what you're told. You're happy to have the job. You want to succeed. They're telling you how to succeed. So you follow instructions. And that's what these guys did. One guy did it for 13 years. Another guy did it for 11 plus years. But the point is, I'm not excusing either of them for doing something wrong. At some point, they should have known better. Okay, but it wasn't completely all their fault in that they were doing basically what they were told. They were doing basically what J.P. Morgan laid out to them for what they had to do and how they would be rewarded and what have you for doing a good job, and they did it. And I think that's the bigger story here. The bigger story is that these guys just weren't born with some kind of genetic defect that led them to spoofing. They were basically following the instructions of their employer, J.P. Morgan. And in doing so, it casts a very harsh spotlight on J.P. Morgan as basically institutionalizing criminal activity. And I'm surprised that the Justice Department doesn't see this, or maybe they don't want to admit it. But they're not going to be the only two that did this, the only two traders. And other shoes are obviously going to fall. But I think we should all sit back and think a little bit about what it's like to be a 23-year-old again and following instructions and wanting to keep your job and wanting to succeed at it, and question where does this all lead us? How can we allow an institution like J.P. Morgan, okay, to even participate in the gold and silver markets, no less being the dominant force, the main force? As you know, I've contended that for more than a decade, and it would seem to me that this second guilty plea would put the good housekeeping seal of approval on J.P. Morgan being, institutionally up to no good.
Yeah. I mean, that's systematically that you're correct. When you look at the bigger picture of the thing, J.P. Morgan, with the fact that the directors had obvious knowledge of what was going on, the U.S. Department of Justice has said that twice now on their website, and alluded to this being much more systematic. My expectation then is that next year it could get a little bit larger, this situation. At least that's my hope. Maybe we'll learn a little bit more, and there'll be more justice to come.
Yeah, no, it's good. I hope that's the case.
Yeah. So moving on a little bit more positive, we spoke about 9 months ago, and silver and gold since that time have been moving much more positively. There's been, a lot more bullish trend going on with those two precious metals of late. The past 3 months, though, there's been some irregular movements in specifically in the silver ETFs, the largest silver ETFs. And I know you had a back and forth a little bit online about this potential large silver whale trade that was going on, and who is this large silver whale, et cetera, et cetera. But I was looking at the charts this before we got on the call today, and I shared with you through email. Obviously, you knew about this. You had been hammering the table to your subscribers about how much silver bullion was flowing into SLV and into a few other ETFs. It looks like over 100 million ounces of silver bullion has flowed into these large ETFs in the last 3 months, and roughly around $3 billion has moved into these ETFs since the start of the year. I wanted to get your thoughts on what you think is happening here. What's going on? Why is there so much silver interest going on with these derivatives?
Excellent point. I mean, it's basically unprecedented, this amount, 100 million ounces of silver being deposited into three silver ETFs. But I would step back just a minute and say there was two discussions here. One was a while back about the potential silver whale which basically was a terminology assigned to a very large trader that emerged on the COMEX futures market. It's a derivatives market, okay, contract market. It's not purely a physical market. So data from the weekly Commitment of Traders report, the concentration data, indicated clearly that somebody big had come into the COMEX silver futures, the paper derivatives contracts, to the tune of about 20,000 contracts, which is around 100 million ounces. So that was one separate, and then there was a discussion as to who it might be, et cetera. But there was no discussion that a very large trader had come into, starting particularly at the end of May, from the end of May to the end of June, okay, basically almost 20,000 contracts, 100 million ounces, okay, had been bought in COMEX silver futures contracts, okay, at that time. Now, separate and distinct from that, since June 25th, okay, that position, that silver whale position, for lack of better terms, which it did exist up until June 25th, has basically gone away. The question is whether the silver whale just swam away, or did he sell? What did he do? But basically, that position since June 25th through the most recent last week's Commitment of Traders report has basically disappeared. It's no longer there. So we had roughly 20,000 contracts, 100 million ounces being put on and bought by a big silver trader, and that same 20,000 contracts are close enough thereof to call it that, being liquidated over the next couple of months. So what happened? Had it been a straight sale, a straight purchase and sale, guy bought 20,000 contracts, okay, of silver, 100 million ounces, and sold it out, okay, at a buck and a half profit. He'd probably have $150 million profit. Ain't bad. Anybody would take that for a quick trade, but I don't see signs that it was sold in that manner, in a plain, vanilla, straight sale manner. Where it gets interesting is what you brought up, James, which is namely this 100 million ounces of physical silver now, not paper derivatives contracts, 1,000-ounce bars of silver, okay, that have come into, okay, these three big silver ETFs, the SLV, the SIVR, and the Deutsche Bank silver ETF, principally. Basically, they look to be, in normal parlance, okay, completely separate and distinct. Okay, one has nothing to do with the other. One is a paper derivatives contract. One is, a physical movement of 100 million ounces. Well, the fact is that it's such an unusual amount of silver, okay, 100 million ounces, that it's not possible that they're not connected. This big futures position being put on and subsequently taken off, and this giant growth of 100 million physical ounces in silver. What it comes down to, basically, as far as I can tell, is that whoever bought these silver futures contracts originally, okay, somebody big, bought $1.5 billion roughly of silver futures contracts, didn't put the full amount of money up, just put the margin up, et cetera. But he or she was had enough foresight, okay, to know that he doesn't want to sit. He or she doesn't want to sit with a futures contract forever. And by the way, this is about the amount of silver that the Hunt brothers bought on the COMEX as well, and Warren Buffett bought back in 1997 on the COMEX as well. So it's an unusual amount. It turns your head, gets your attention, and it seems to me that they're connected. The purchase and liquidation of the futures contract and this tremendous growth in the silver ETFs of physical silver. And in hindsight, I mean, I didn't anticipate that this was going to happen, but watching it unfold, it appears clear to me that this was one and the same transaction, and whoever did it knew what he was doing, he or she was doing, and they bought 20,000 contracts of COMEX silver futures and then converted them, didn't sell them, converted them via a very simple arbitrage. It's so simple. It's like it's not a difficult thing to do, but they converted their silver futures derivatives contracts into physical silver. Now, what happens next? It could be anything. He or she who owns this physical silver now in these ETFs could just sit with it and leave it there, or they might go one step further and convert this physical 100 million ounces of physical silver, okay, into wholly owned silver by just taking it out of the trust, basically, and allowing somebody to store it, probably the same parties, to store it on an individual basis. So that silver may actually come out at some point, but it's just a change in the form of ownership. The ownership would still be there. It's a beautiful play. I mean, it's something I wish I was smart enough to see beforehand, before it took place. And I wish I was in position to buy $1.5 billion of silver at $15 an ounce, which was the actual cost basis. And now whoever did it is sitting with 100 million ounces of physical silver and all the upside ahead for as long as the price may rise, okay? And he or she did it, okay? It was masterful. It was one of the best. When the Hunts bought it, but they had an intent. They wanted to drive the price up, and they drove the price up by buying silver, as we all know. Warren Buffett didn't want to drive the price up too much, but he did succeed in causing the price to double from $4 to $8 with his purchase of around 100 million ounces. Whoever did this one was even better than both of them, because he or she bought 100 million ounces of silver, and it's only been up $2 or $3, and that's the mark of a good trade, because the idea is to buy as much as you can of a cheap asset without causing the price to go up. So I give my hat is off to whoever did it. Maybe we'll know who it is in the fullness of time. Maybe not. Okay, but it doesn't change the fact that it was like a beautiful trade, and it portends good things in the future, because somebody doing this has a bullish view on silver, and now that he or she has completed the transaction from converting it from the futures position to a physical silver position via the silver ETFs, they're free to do it again if they got another $1.5 billion.
Well, speaking of having another $1.5 billion, a lot of the research I've done regarding the Warren Buffett trade in the late 1990s and the Hunts in 1980, and in the 70s as well. I did some research on. You've talked about it before. I've read your work many decades online, and you've talked about just how tiny indeed the silver market is in the physical realm, as far as, in this financialized economy that we live in. If you go and look at like the Forbes billionaire list right now, I mean, we have various people who are over the $100 billion threshold now on paper. And so, I mean, just the very idea that someone would have about $1.5 billion to kind of shuffle off into silver because they're bullish on the metal, it's not out of the realm of possibilities. You have thousands of billionaires in this world, and the question is, does one or two of them have a bullish view on silver? I know Bill Gates obviously learned a lot about silver from Warren Buffett, his buddy, in the 90s, and he was very bullish in silver mining stocks around the late 90s, early 2000s. He made a lot of money, I believe, in some of them. And so, just to add on to your thoughts about 1.5 billion, in silver is really not that much money in the grand scheme of things. How tiny the silver market really is.
Oh, absolutely. And the amount of money is even less every day in the in the current age that we live in, but it is 100 million ounces is still a heck of a lot of silver, and that's the big takeaway is we got lots of money out there. We don't have that much silver, and in fact, very little of it to invest in, and that's what makes this recent transaction, whoever did it, okay, look like the greatest trade ever, because he took what wasn't that tremendous amount of money and ended up with a tremendous amount of silver, and that's what it's all about.
Yeah, and still we have a gold silver ratio hovering around 88, and he didn't make that big a wave by doing it, or she didn't make that big a wave by doing it. So Ted, you mentioned in your recent writings that you sent to me before the interview that there's some pretty big unrealized losses right now with the 7 big shorts in the COMEX gold and silver markets. I wondered what your thoughts on that are in terms of the potential moving ahead of perhaps a retracement of price for gold and silver, or are we starting to kind of take off here and these guys going to get caught on the short side here and start having even larger losses potentially?
Well, James, I think that's the key question. I wish I could give you the answer,
Sure.
and I would if I could, but I don't know what the answer is going to be. But it's going to be one or the other. It's going to be that there's always been. I just talked about the concentrated long position that was converted into a physical silver via the ETFs. But all along, I mean, for the last 30, 40 years, there's been a concentrated short position on the COMEX in silver that has been the price depressant factor. It's been why price of silver is so cheap, is because we still have a very large concentrated short position. I've taken to eliminating J.P. Morgan from the list of big shorts. I still think they're a very significant short, not the biggest anymore, and I think J.P. Morgan's trying to work its way out of its short position, but it's already done that by buying, as I've said over the years, a tremendous amount of physical, both silver and gold. So they have enough physical silver and gold that that doesn't really make a difference what their J.P. Morgan short position is on the COMEX, because there's no way they can lose money. I mean, they got so much more physical silver than they're short on a paper basis, same thing with gold, that they can't lose. In fact, the other day, last week or so, I made the calculation that on their net gold holdings, I think they have like 25 million ounces of gold physical. They've got maybe 50,000 contracts, which is basically 4 or 5 million ounces short on the COMEX. They're net long 20 million ounces of gold, okay? And on that 20 million ounces of gold, which they accumulated around $1,200 an ounce, they're ahead $300 or $6 billion. So this game may just be starting to warm up, particularly in silver, but already J.P. Morgan is billions of dollars ahead on the price rise that we've had so far. But J.P. Morgan is the only one that I've been able to see uncover that has any physical silver or gold of these remaining shorts, the 7 remaining shorts. Might be 8, maybe 10, but J.P. Morgan is not included anymore in my calculations because they got so much physical, they're good to go no matter what. These other guys are not so lucky. I don't think they have any physical gold or silver to speak of, so their short position is a problem, is naked, if you want to call it that. And right now, based on the price rise that we've had so far, more in gold than in silver, and I combine them in my mind because anybody who wants to be a big short on gold is probably crazy enough to be a big short on silver as well. So they may not be exactly the same 7 traders short in both gold and silver, but probably they are. Probably it's close to that. And based on the price rallies that we've had so far, okay, from their average price of going short on silver and gold, $13.50 on gold and around $15 or so on silver. They are basically, as of last week, a little bit better this week because the price is a little bit lower. They're out. These 7 traders are out like $4 billion. Now they didn't have to. These are not realized. This is an open and unrealized loss. So they haven't eaten the loss in terms of closed out the position and booked the loss yet. And it may turn out that they may succeed, as they have every other time over the last 30, 40 years, in causing the price to go down, rigging the price lower, to where they can buy back these open shorts at a break even. I don't think they can make a big profit on it now, but they might be able to break even. And if they did break even, they will have avoided and evaded taking $4 billion in losses. So that's the way it normally turns out. That's the only possible reason that we would go lower in price if these 7 big manipulators, on the COMEX did succeed in driving prices down, getting all the technical funds to sell, etc., and then they'd be able to escape with their skin, these big, say, close to $4 billion loss that they're staring at right now. However, on the flip side of that is that they didn't, I don't think intentionally, nobody would, put themselves in a position of being on the hook and out $4 billion in a $4 billion hole on an open and unrealized basis. So there's no guarantee that they're going to succeed in knocking the price down and buying back their shorts, as they always have in the past, always, They might fail, and there's a good chance of it just from a financial point of view alone, and may not be able to succeed in knocking the price down, especially in silver, where we already see somebody come in and gobble up 100 million ounces, $1.5 billion worth. And if there's any more behind that, then these big shorts on the COMEX might be in trouble, and for the very, very first time might be forced to buy back their short positions at big, big losses, even bigger than the $4 billion that exists collectively today on a gold and silver combined basis. And if that happens, and it's one or the other, I think, they're either going to succeed and knock it down, and we're all going to be crying in our beer again about what a crooked market it is, and how these crooks, drove it down again, succeeded, or we're going to be celebrating, not crying in our beer, and watching these guys get overrun to the upside, and be forced would send a rocket under the price, particularly of silver. If these guys turn from the ultimate sellers of last resort to buyers, because I don't know who would sell at that point. The price would just take off. So I think it's going to be one or the other. I wish I could tell you which one it was going to be. I'm sure you know which one I hope it is, Probably the same one you're hoping for, and anybody else that's listening to this. But the fact is, we're going to see. We're going to see as time evolves.
So, Ted, you've been in this game for a long time. I wanted to just take it back a little bit from the last major bull run for silver and gold, from 2009 to roughly 2011, the price running from 9 to 50. Who in this short, the COMEX short silver and gold, which of these major commercial banks or traders do you think took really large losses during that big run up? Were there any major shorters at the time that you heard about taking losses, in that run?
Bear Stearns.
Yeah, right,
they went out of
course.
business. They went out of business. So they have to stop right there. No, but the fact of the matter is beyond that. Bear Stearns was back in 2008 when silver got to 21. It wasn't around when it got to 50. The simple answer, it's a good question. The simple answer is, what drove the price of silver that last $25 higher from 25, in the fall of 2010 to $50 at the end of April 2011 was not COMEX positioning. There was no, everybody was, as far as the futures contracts were concerned, the futures positioning on the COMEX, it didn't change. Whoever was long and short at the beginning of the move was long and short at the end of the move. It wasn't big changes, short covering, or anything new buying that came into the COMEX futures contracts. It was strictly a physical thing. People plowed in to the various silver ETFs. SLV, Sprott came out with his big silver ETF at the time, and that's what drove, in my mind, that's what drove the price of silver up. There was big losses. I mean, J.P. Morgan alone was probably out about $3 billion on silver, okay, on the run up to $50. But these sons of guns, they didn't blink once, okay? Maybe they did privately, but they didn't publicly, and they just rode it out. There was a big open losses, okay, unrealized, and they had enough money. They just rode it out. They did other things to cause the price to eventually come down starting May the 1st. But so they rode the whole thing out. What I'm suggesting this time, though, is J.P. Morgan didn't have any physical position back then. Okay, they do now, and they're in position to let this thing run away to the upside. And I can't say laugh all the way to the bank because they are the bank. But these other guys, these other big shorts, they'll be crying, they'll be hurting. We'll see the bodies, okay, float to the surface if we start to run up in silver from here.
So, Ted, to kind of close this out, we got this strange world that we're living in. You know, we'd mentioned these 100 billionaires who are living in this fiat fantasy world that we live in now. We have 16 trillion in negative interest rate bonds. You know, they're growing in the world. We got further interest rates coming from the Fed, probably, you know, potential QE programs to come, and maybe MMT-like excuses to print and create Fed coin and what have you. I wonder, you know, can you even believe the fact that you can still get silver bullion for like $18 right now? And in your wildest dreams, did you ever think you would see a more bullish setup for silver than we are currently sitting at?
I kind of pinch myself every day, the exact thought and question that you're asking. I don't understand what a lot of things are that are going on in this world. I don't understand negative interest rates. It's just the concept. It just escapes me. But it just, of all the things that are so crazy with this explosion of monetary buying power and the prospect of more to come, I look at silver and I say, of all the things around, that is like nothing is cheaper than silver, and we're in an environment where there's just unlimited buying power. The two have to meet at some point, as you're suggesting, and I couldn't agree with you more. I mean, everything that's going on today in the macro world, okay, just accentuates what an incredible bargain silver is at current prices.
Well, Ted, I really do appreciate you taking the time this week coming on our show, and just all the work you've done over the last many decades, just getting people to understand. I mean, you were on the internet when it first, you know, was cutting edge to be on the internet and talking about silver a long time ago. So, you know, on behalf of our listeners, I just want to thank you for all the work you put into it. And hopefully this decade coming up is going to be really bullish for silver, and we're all going to benefit from the positions we've taken.
Amen. Thanks a lot, James. I appreciate it.
All right, Ted. Thank you so much.